Let me ask you something. Have you checked your portfolio lately and then immediately wished you hadn't? Yeah, me too. And here's what's wild. Markets are actually up year to date. On paper, things are fine, but it doesn't feel fine, does it? The headlines are relentless, the uncertainty is real, and the gap between what the number says and what your gut feels is exactly what makes this moment so dangerous for every investor. Because when things feel scary, people make scary decisions. They sell what they should hold. They hide when they should be building. And they lock in losses right before the recovery starts. Hi, I'm Ravi. Welcome back to the channel. Today, we are going to cover what's actually driving market anxiety right now, walk you through every major question investors are asking, and give you a clear practical framework for what to do and what not to do when the market feels like it's unraveling. This is a longer one, but stick with me. By the end of this video, you will have more clarity than 90% of people talking about market right now. So let's get into it. Before we talk about what to do, let's make sure we understand what we are actually dealing with. Because the market feels scary isn't specifically enough to act on. Right now, there are several overlapping sources of uncertainty hitting at the same time. Geopolitical tension is elevated across multiple regions simultaneously. That's unusual. Normally you get one hotspot. Right now, there are several, and they are all touching global trade in some way. Monetary policy is genuinely confusing. Central banks have been talking about cutting rates for a year. Sometimes they do, sometimes they pause. The signal keeps shifting, and market hates ambiguity more than almost anything. AI spending. This one is interesting. The narrative that AI would drive an endless wave of tech earning is getting its first real stress test. Companies are spending enormous amount of AI infrastructure. Investors are starting to ask, when does this actually translate to profits? Valuation, particularly in US large cap stocks, are stretched by almost any historical measure. That doesn't mean a crash is imminent, but it does mean there's less margin for error. And underneath all of this is a deeper, hard-to-name feeling that the global order that governed market for the last 30 years, stable alliances, predictable trade, globalization, is shifting in ways nobody understands yet. That's a lot, and it's okay to feel unsettled by it. Now, here's what we are going to do about it. Should I move to cash until things calm down? This one is the number one question I get in comments, DM, emails, everywhere. And I want to give it the respect it deserves because it's come from a completely rational place. When things feel dangerous, you want to protect yourself. That instinct isn't stupid. In most areas of life, it's actually smart. But in investing, it almost always backfires. Here's why. To profit from moving to cash, you need to be right twice. First, you need to sell before the worst of the drop, not after you have already watched it fall 15%. Second, you need to buy back in before the recovery gets going, not after you have seen 3 green weeks and feel safe again. Most people, including professional fund managers with entire research teams, cannot do this consistently. The data on this is overwhelming. Active funds that try to time the market underperform simple index funds over almost every long time horizon. And here's what actually happens to everyday investors who try. They watch the market drop. They feel the pain getting worse every day. Finally, around the point of maximum fear, when every headline is catastrophic, they sell. They have locked in the losses. Then they wait. They want to see stability before getting back in. But by the time things feel stable, the market has already recovered 20, 30, sometimes 40% from the bottom. So either they miss the recovery entirely or they buy back in near the new highs, having sold near the low. That is average investor experience when they try to get safe. It's not a character flaw, it's just how human psychology interact with market. Now here's what I want to be clear about. If your current portfolio genuinely keeps you up at night, if you are losing sleep, checking prices obsessively, feel anxious, that's important information. It means your allocation doesn't match your actual risk tolerance. The solution to that is adjustment, not abandonment. Maybe you shift from 80% stock to 65%. Maybe you add some bonds or alternative assets. That's a reasonable, thoughtful response to discomfort. Going to 100% cash, that's panic in a nice outfit. And it almost always costs you more than the things you were scared of. Geopolitical risk. How scared should you actually be? Let's talk about geopolitical risk specifically, because I think this one deserves more nuance than it usually gets. The honest answer is yes. Geopolitical events can and do hurt markets, significantly sometimes. The market impact of a major conflict, a surprise election result, or a sudden trade disruption can be a swift and brutal in short term. So I'm not going to tell you don't worry about it. That would be dismissive. But here's what history tells us, and this is worth sitting with. Every single major geopolitical crisis of the last century has eventually been followed by market recovery. World War II, the Korean War, the Cuban Missile Crisis. Genuinely, the closest humanity has come to nuclear war, the oil embargo of 1970s, the Gulf War, 9/11, the 2008 financial crisis, COVID-19. Every single one. The investor who held through those moments, or better yet kept buying through them, came out ahead. The one who fled to safety locked in their losses and missed the recoveries. Now I want to add an important caveat here. This doesn't mean every market recovers from every event. Individual countries, individual sectors, individual companies, some of them genuinely doesn't recover. This is why diversification matters so much, and we will come back to that. But for a global diversified investor, the pattern is consistent. Crisis creates fear, fear creates selling, selling creates opportunity, market recovers, patient investors win. The trick is surviving the crisis psychologically, which brings us back to your allocation, making sure you're not so exposed that you cannot hold on when things get bad. Are stocks too expensive? What evaluation actually tells us? This is where I want to spend some time because valuation is probably the most understood concept in retail investing. Yes, by most measures, US stocks are expensive right now. The Shiller PE, the price to sales ratio, the price to book ratio, they are all elevated compared to historical averages, particularly in large cap US tech. That's real. That's not a spin. It's the math. But here's the leap that people make. And where's the logic breakdowns? Expensive does not mean about to crash. Markets can stay elevated valuation for years. The late 1990s saw stretch valuation from roughly 1995 all the way to 2000. 5 years of overpriced market that kept going up before it finally corrected. Investor who exited in 1996 because things looked expensive missed one of the greatest bull run in history. Valuations tell you something about expected long-term return. When stocks are expensive, future expected return are generally low. That's useful information, but it tells you almost nothing about what happens next month, or next quarter, or the next year. So what do you actually do with this information? First, you diversify internationally. Non-US market, Europe, emerging market, parts of Asia are trading at significantly lower valuation than US right now. A global diversified portfolio naturally has more exposure to cheaper market without you having to make a big call. Second, you diversify by sector. Not every part of the US market is equally expensive. Healthcare, energy, financial, these markets are much more reasonable multiple than mega cap techs. Third, you kept investing. If you're contributing regularly, you're naturally averaging into the market at various price points, which takes some of the timing pressure off. What you don't do is try to call the top and sit in cash waiting for a better entry point. That strategy has a terrible track record, and cost of being wrong is enormous. Inflation, deflation, recession, soft landing. What do you even prepare for? I want to take a moment here to acknowledge something that I think is generally underappreciated. The macro environment right now is unusually hard to read even for professionals. I'm not saying this to be dismissive of economics. I'm saying this because right now, if you go read serious economic forecasts, you will find credible, well-resourced analysts predicting almost every possible outcome. Inflation reignites as tariffs push up prices, or deflation emerges as the economy slows. Recession hit by Q3 or soft landing, growth continues. Rate cuts accelerates or rates stay higher or longer. These are mutually exclusive outcomes. They cannot all happen, and a significant number of these forecasts will be wrong. This isn't a knock on economists. Forecasting complex system is genuinely hard. The lesson is simply this. Don't build your portfolio around a single macro prediction. The investor who goes all in on inflation is coming and loads up on commodities get destroyed if we get deflation instead. The investor who goes all in on recession is imminent and hides in bond misses a continued equity rally. The right approach is to build a portfolio that is resilient across multiple scenarios. In practice, that means equities for growth, bonds or other defensive assets to cushion downturns, some real assets, real estate or commodities as inflation protection, geographic diversification so you're not 100% dependent on any single economy. You won't have the best performing portfolio in any one scenario, but you also won't be catastrophically wrong in any scenarios. And over the market full cycle, the resilience beats optimization almost every time. The psychology of investing in scary market. I want to talk about something that doesn't get enough airtime in personal finance content, the psychological side of this. Because here's the thing, most people intellectually understand that they should not panic sell. They believe it in the abstract, and then the market drops 12% in a week. And suddenly all of that intellectual knowledge evaporates. And the only thing that can feel is, get me out. There's a name of this in behavioral finance. It's called loss aversion. And we are all wired to it. Losing $10,000 feels roughly twice as bad as gaining $10,000 feels good. That asymmetry is baked into our psychology. It's not a character flaw, it's human, but here's what makes investing so counterintuitive. The market is specifically designed to push you for following that instinct. It drops when fear peaks, which is exactly when loss aversion scream at you to sell. It recovers before things feel safe, which is exactly what most people are still too scared to buy back. The practical implication of this is that your portfolio construction needs to account for your psychology, not just your spreadsheet. If you can look at 20% drop in your portfolio and genuinely stay calm and keep contributing, great. You might be built for a higher equity allocation. But if a 10% drop is going to make you lose sleep, and honestly know that at some point you will panic sell, then you shouldn't be at 100% equity, regardless of what the math says about long-term returns. A lower return portfolio you actually stick with will beat a higher return portfolio you abandon at the worst moment. Know yourself. Build accordingly. What you should actually do right now. All right. All of that context leads here. Let's make this concrete. Step 1. Review your allocation calmly and deliberately. Pull up your portfolio. Look at your actual mix of stocks, bond, international versus domestic sectors. Ask yourself, honestly, if this dropped 25% tomorrow, would I hold? If the answer is genuinely yes, you're probably fine. If the answer is I don't think I could, then adjust now, before a drop, not during one. Step 2. Check your diversification. Are you overconcentrated in one country, one sector, one company? Now is the good time to audit this. Not to panic sell, but to make sure you are not accidentally running a concentrated bet disguised as a diversified portfolio. Step 3. Keep contributing if you are in your accumulation phase. This is so important. If you are years away from needing this money, market dips are not your enemy. They're actually a mechanism that lets you buy more asset at lower prices. Every dollar you invest during a down period is working hard for your future self than a dollar invested at a peak. Volatility for accumulators is actually a feature. Step 4. Know your time horizon and actually respect it. If you are 25 and investing for retirement, today's headline will be completely forgotten footnote by the time you retire. Seriously, you will not remember what was in news this week in 2045. If you need this money in 2 to 3 years, then it should not be in volatile assets right now. But that's a planning issue, not a reaction to current events. Step 5. Stop checking your portfolio every single day. I'm serious. The more frequently you check, the more likely you're to make an emotional decision. Weekly at most. Monthly is better. Quarterly is fine. The more distance you put between yourself and the daily noise, the better your decision will be. Look, I'm not going to pretend that investing through uncertain time is emotionally easy. It isn't. The discomfort is real, and it's okay to feel it. But discomfort is not a signal to act. Sometimes, actually, it's a signal to hold and trust the process you set up when you were thinking clearly. The investor who built real wealth over time aren't the one who made brilliant tactical calls during every single crisis. They are the one who stayed diversified, keep contributing, didn't panic, and let decades of compounding do the work that no amount of clever market timing can replicate. That's the whole game. It's simple. It's not easy, but it's simple. If this video gave you some clarity, please hit the like button. It genuinely helps more people to find this content when they need it. Subscribe if you're new here and drop your biggest investing question in the comment right now. I read all of them and your questions shape what we cover next. I'll see you in the next one.